Hi everyone, welcome back to Financial Mindset. Today we will discuss about the IPO process in detail using our story of Samir and Kabir. Samir has already told Kabir why companies launch IPOs, but Kabir still has a few questions. Like how does an IPO actually happen? What goes behind the scenes before shares reach our demat account? So both of them decided to discuss about the IPO process in detail when they next meet. Kabir asks, can you explain the process of IPO? Samir replies, definitely. The first thing that they do is they appoint the investment banker or an underwriter. Then they file the DRHP with the SEBI. After that, the price band is decided. Finally, the allotment of share is done through the process of bidding. Kabir says, can you explain in detail about each of these processes? Samir replies, let's start one by one. So we will start with underwriters. Underwriters plays an advisory role. They help the companies in deciding how much money to raise, determine how many shares to issue, deciding the price band, etc. They also help in due diligence along with preparing DRHP and providing underwriting facilities by promising to buy any unsold shares in the IPO. The next one is DRHP or the draft red herring prospectus. It is basically the complete biography of the company. It contains business model of the company, financial history, risk involved, details about management, the reason for raising funds, etc. SEBI plays an important role by making sure that the company isn't hiding any information. Kabir seems to be amused to see how all of these work. He asks Samir to continue. Samir continues. So the next is how the IPO price is decided. It is based on business valuation, investor demand and market sentiments. There are basically two ways by which IPO price is decided. The first is fixed price method. This is not a common method these days. The second one is book building method. This is the most used one. So we will discuss the book building method in detail as fixed price method is rarely used and it does not allow the market to decide the price. In the book building method, the company announces a price band, say from rupees 18 to 20, and invites the investor to bid for shares in this range. The price at which they get the enough bids to cover the shares offered is called the cutoff price and it finally becomes the IPO price. Kabir asks, what if there is not enough demand at the minimum price that is rupees 18, then what? Samir replies, then the IPO may get withdrawn or revised, but generally companies consult deeply with investment bankers to avoid such situation. Finally, Kabir asks, so what happens if way more people apply than the shares available and what all happens after allotment? Samir replies with an example. Say 10 lakh people apply, but there are only 1 lakh shares. Then in this case, 1 in 10 may get allotment. In heavily subscribed IPOs, allotment for retail investors is often lottery based. After this, the shares get credited to demat account and finally on the listing day, shares start trading on the stock exchange. Price of the share after listing goes up and down as per the market demand. Finally, Samir warns Kabir about some of the common myths about IPO. People generally think of IPO as a way to get quick profit and they apply to each and every IPO without researching and even without reading the DRHP. Investing is a process and one should always do proper research before investing. So this was all about IPO. For more such videos, do like, subscribe and share. This video is only for educational purposes. Any information provided in this video is not to be assumed as an investment advice. Characters in this video are completely fictional. Please consult a professional before investing.